Hello, everyone. My name is Nanette Jacobson, and I'm a global investment strategist at Wellington Management Company. It's been a challenging quarter, no question about it. So what's going on? Uncertainty and fear are definitely driving markets right now. And a big part of what's going on is not only the fundamentals, but also technical issues in the market, where ETF selling and other passive strategy selling is forcing prices lower. We have had emergency responses both from the Fed and the government. $1 trillion of purchases announced by the Fed, all types of collateral, and the government in the United States is also putting together an enormous fiscal package. And all of that does give me some optimism. So what can you as an investor do in this kind of environment? I think it's important that everyone have a game plan. It at least gives you some control over your finances. For me, my game plan is to stick to my investment process. And my investment process is to look at three inputs. First is fundamentals, second is valuations, and third is policy. Fundamentals and policy right now are the most important aspects of your game plan. What I'm expecting for the fundamentals is for there to be a sharp but relatively short global recession. Over the near term, it means that volatility is likely to persist and there might be further sell-offs in the equity markets. Investors who do have liquidity, who do have cash, should stay invested and frankly use this as an opportunity to pick up some extraordinary opportunities. So what can you do over the next 12 months? I would really focus on the highest quality companies, and I'm recommending a prudent strategy both in the equity and the fixed income markets. By high quality companies, I'm talking about companies that are not facing solvency or liquidity issues. The characteristics that are going to be most prized are free cash flow, low debt, good quality balance sheets, and high quality management, and business models that will survive this downturn. So what do you do? What are the practical implications? I'm recommending still to own equities and credit, and within equities to own the lowest beta regions, and that would be US equities relative to the rest of the world. This is the lowest beta, i.e. the least sensitive sector to the global slowdown, and we've also seen the most in magnitude of central bank cuts from the Federal Reserve relative to other regions. Again, you want to look at companies with high free cash flow, low debt, durable business models. Now, I am moderately bearish on emerging markets. In particular, that sector has held up well because the disease is migrating from China and the Far East to other regions, to Europe and to the United States. But I do think there's a risk that growth will be slowing considerably in China, and frankly, that there's a second wave of diseases there. Commodities are suffering from low oil prices in particular and a lack of global demand, and therefore commodities being a very volatile sector of the market, I don't recommend overweights there as well. Again, China represents 50% demand for commodities, and therefore if China growth is slow, that does not bode well for the commodities market. Where I'm relatively more positive is on the credit markets. I am bullish on credit, and I see tremendous valuations in investment grade corporates, particularly in the investment grade side. Double B high yield, that's the top end of the capital structure in high yield. Bank loans, and even municipal bonds, both in the taxable and the tax-exempt sector. So that wraps it up for my recommendations. In summary, I think we may be facing high volatility for a while longer, but it won't last forever. Governments are well aware of the crisis that we are facing, and they are going to be turning out enormous fiscal packages in the trillions of dollars to support the economy, to keep interest rates low. And in 12 months' time, I expect that we will be through most of this. And therefore, investors should stay invested. And if they have cash in their portfolios, to start to nibble at these tremendous opportunities. Thanks for listening.